Assalamualaikum everyone. Today we are going to tell about changes in credit risk model during COVID-19. Before we start our presentation, we would like to introduce ourselves first. My name is Nur Farah Aziz. My group members is Nur Zakia
Hello, my name is Nur Zakia binti Zaharuddin.
and Nur Hazira.
Hi, my name is Nohazira binti Abu Bakar.
Credit risk is a possibility that a borrower fails to pay back a loan at the amount they borrow. It also refers to the possibility that a creditor might not collect the bill principal and interest that they charge to them. It is resulting in disruption of cash flow and growth costs of collection. Purchaser credit risk be able to be measured within the 5 C's. It includes credit history, condition of loan, capital, capacity to repay, and collateral of association. When creditor offers loan, which means credit card or any other loan types, there is a possibility that a borrower may not pay back the loan that they agree to pay. If a company offers a credit to a borrower that are facing financial problems, there is a probability that a customer not pay their invoices at the exact time. It occurs because they do not have a sufficient amount of money. It shows that there is a risk that a bond issuer may unsuccessful to make payment. However, a borrower credit risk can be measured by looking at their financial situation. If they work as a contract employee, the lender might be facing a high credit risk. This issue can be overcoming by estimating the value of its financial account, its financial flexibility, which includes the ability to raise capital, its past financial performance, and its fund suitability. Then, the creditor can look for the market situation and practical efficiency. The lender should be aware of individuals who do not have a constant financial account. Furthermore, it is a specific problem when a sale of credit are focused on a minor number of clients. If a customer fails to repay the loan, this will give an effect to the cash flow of the lenders. They need to find solution on how to overcome this matter by doing a good decision. They can expand the time of payback in order to avoid the risk of loss. Therefore, the company that are expecting the delay of a credit to a borrower can reduce its credit risk. For example, they can expand from 3 years repayment to the 5 years repayment. They will continuously pay even when the amount of payment is reduced. Next, I am going to tell you about how COVID-19 affect the credit risk models. Firstly, it will have an increased loss of income. The retail borrowers and commercial borrowers are facing a significant reduction in their monthly incomes. They are facing a problem in a number of their sales because of COVID-19 situation. The customers will not able to go out from their home to avoid the risk of this disease. The seller is not able to achieve their target sales in a few months because of lack customer. As a result, they need to find other way to ensure that the loan is payable. For example, if a seller is making loan to buy asset for their business, they should find another financial resources to make payment at the exact time. It shows that the situation of COVID-19 gives a bad impact to the income of borrowers. Therefore, the company needs to find out solution during this situation. They should reduce the number of workers in their organization so that they can pay the salary of the workers. As a result, the borrowers do not have financial resources to make payment of the loan. This will have increased the risk of default. Thus, the lenders must make a long-term loan contract to the borrowers in order to reduce the risk of loss. Furthermore, It will be affecting to a low financial and operational leverage. The economic activities will slow down, which can lead in putting a pressure on businesses' cash flow and working capital. The business will be facing a cash flow problems because of the instability of the fund in their account. If they do not plan the strategic method on how to manage the cash flow, they will be facing a loss. Thus, they should manage the cash flow by finding a financial expertise. This will help the business to find out the solution on the cash flow and also the working capital.
So firstly, I'm going to explain to you guys about factors affecting credit risk models. Before that, as you all know, this pandemic situation gives a big impact for all sectors of economy, specifically in banking functions, which is credit risk management. The risk modeling teams are when a financial model is used to calculate quantitative data, such as models and hazards or value transactions of a business. Furthermore, the credit risk models are usually created based on historical data from the last decade that differs in our current situation. Banks also affected by COVID-19 crisis. Banks are looking at credit risk models in order to catch up with the forecasting of the rapid changes. The biggest challenging when in financial institution during COVID-19 is they have to meet the key requirements under the International Financial Reporting Standard, which is called as IFRS 9. The key to reduce the level of credit risk is where the lenders should measure credit risk with better accuracy. There are few factors affecting credit risk models. The first one is probability of default, which is called as POD. It's the probability a creditor fails to meet their obligations to pay back. For example, individual borrowers are the combination of two variables which are credit score and debt to income. However, the POD is acquired from credit rating agencies for corporate borrowers. If someone shows that he or she able to a lower probability of default, the loan also will offer with low interest and low or no down payment needed. Secondly, loss given default, or we call as LGD, is defined as the lender have to bear the total loss if borrower could not meet the obligations to pay. In addition, both borrowers have different credit profiles, and in conjunction of that, the lender tend to suffer more loss when another borrower's default. Usually, the lenders a whole loan portfolio to determine to the exposure to loss as there is no standard practice of calculating LGD. And lastly, exposure at default, or we call it as EAD, is a significant term that applies to both individuals and corporate borrowers. It is determined by multiplying a certain percentage of each loan obligation, which is adjusted on the basis of the loan information. This defined as amount of losses that lenders have to bear and is exposed to more risk. Do you guys ever wonder if credit risk models have a tools? So let's take a look of the example of the credit models that Ben focused on. Next, we are going to see the examples of the credit risk model that Ben used. So there are few examples of credit risk models that bank focus on. Firstly, application scorecards. It is actually tools that let an institution to assume that it is typically statistical models are built using historical data for the specific product and if the data is available. However, if the historic data is not available and the scorecard in need for a new product, then from their comprehensive data sources, Experian can give representative generic data from their large data sources. Next, the second one is the behavioral and collection models. It is the flexibility in systems and models to exclude creditors under packages, moratorium, or relief. Behavioral scoring is also known as one of the most crucial tools for the accurate and cost-effective evaluation of accounts by collection management. In addition, there are few key differences that convince this behavioral is a better option for many workflow systems for account management applications and collections, even though behavioral models are similarly designed to new applicant models. So the third one is stress testing. It is where adding extreme and dramatic scenarios are strongly advised. The banks would draw some observations from the stress test models from the West, for example, CCAR models. And the fourth one, lastly, IFRS forward-looking. It is recalibrate current models of macroeconomics linkage with specific factors driving the default risk factors. It is possible to explore and integrate structural stability tests into regression models. That's all from me. Thank you.
I want to explain to you about what are the way to overcome this credit risk. Okay, as we know, most of financial institutions use credit risk modeling as a technique to know probability of a default, the level of credit risk of a potential borrower. It provides information at any particular time about level of credit risk to borrower. If the credit risk is not known in advance by the lender, it will expose them to the loss of funds and risk of default. It also gives the negative impact to the lender by disrupting the consistency of cash flow. Okay, firstly, they have to know about the customer, which is the lender have to know about their customer by check their new customer credit record carefully, like verifying the identity profile and financial condition of a client before doing business with them to avoid any losses. They also have to check their creditworthiness and make periodic inspection check on the existing client throughout the customer life cycle. However, it can be tricky to find foreign corporate data, especially for emerging market, but the local consulting firm may be able to help them to find the data. Next is establish accurate credit limits. To set credit limits accurately for a new customer, lenders have to spend more time to examine about their customer finance. They have to check the credit agency report, which can provide all the detailed information about their company financial history. Check audited financial statement is also a must. It can provide clear view of liquidity, profitability and cash flow of their customer company. They also have to check bank report that can help them to provide information of the bank relationship with the customer. Okay, thirdly is conducting due diligence. The lender must often review their customer company business profile and analyze any financial statement when assessing client creditworthiness. By performing a direct check, the lender also can learn a lot about their customer organization. The lender also can use a reliable credit reference agency for more in-depth due diligence. Okay, lastly is understand the various sectors they work with, which is this insight will assist them to understand the supply chain better, since a supply chain is fundamentally related because they can affect each other. The issue of the customer also can become the lender problem because if they don't get paid, the lender may not either. That will help them to understand their customer and their credit risk. Okay, that's all. Thank you.
That's all for today. Thank you for listening. Assalamualaikum.